Good morning, everyone. Welcome to the general market update for global stocks and commodities for the 11th of May. This is going to be a pretty short video because in the last week there's been virtually no change to anything. Stocks basically unchanged, commodities virtually unchanged. So it's pretty much the same as it was last week. But let's take a quick look anyway. The S&P was down by 3 points on the week, which is certainly very little movement. The Nasdaq and Russell 2000 indices, covering the technology and the smaller cap end of the market, did remain a little bit weaker, but they did stabilise. So the falls that we'd seen over the previous few weeks did manage to stabilise out. And I think the key point that needs to be made about the American stock market at the moment, despite some of the doom and gloom predictions about a crash, is that economically America's going along quite well, and from a stock valuation point of view, the last round of the earnings season definitely showed that the price gains last year in anticipation of the profits have been supported. Those profits have come through. Valuations are still reasonable in most cases. There are some stocks like Facebook and Amazon, etc., are still a little bit, a lot overvalued and will probably continue to fall in price. But they're the exception, not the rule. So from a general valuations point of view, there is no reason for the indices to go down in America. The Aussie stock market, also very little change here. We gained just 2 points for the week, and look, sectors were just flat. Every sector did virtually nothing. And it's just all low volume activity, so it really doesn't bear any comment at all. Let's just have a quick look though at the charts. So we'll start with the S&P, and you can see that it's just holding up there. Now it hasn't gone on to form a new high, but equally the ranges are quite small. There's very little volatility. The last little run down didn't even get down to the 150-day moving average, which has been the support area for quite a long period of time. You've really got to go back to, get back into 2011 before we saw the 150-day moving average flatten out and get breached for any length of time. We had a few very brief excursions here, but really just a matter of a day or so. And this time round, as you can see, hasn't even had enough selling pressure to get down to that level. So I think it's quite likely that the S&P index might just move in a sideways band for the next few months. This traditionally weaker period of the year, that might be all that we see. So anyway, we'll have to wait and see on that. Let's look at the Nasdaq. You can see a little bit weaker, further down off its highs, but it also has failed to breach the 150-day moving average support. It's just flattening out just a little bit. So again, trading range would make sense there. And if we look at the Russell 2000, a little bit weaker again, but it's only marginally below that the support of that moving average. I'm looking for perhaps a little bit more downside, maybe down to around about 103, 104 on the Russell 2000 ETF. But look, it's all pretty mild stuff at the moment. Nothing to really worry too much about. Turning to the Australian market, if you look at the sector indices, this is the materials index, so largely BHP and Rio. You can see it's pretty much sideways. Hasn't really got back into gear yet. Still in a big phase one base overall, which really started around about May of 2012. So about 2 years ago, the value of the major mining stocks stopped falling, but they've really been caught in this big band for the last 2 years, and there's very, very little change there. Looking at the Australian small caps, this is the Small Ordinaries Index. We had a sudden dip there in June of 2013. But take that dip out of it, and it's, again, really just been trading sideways since 2012. So nearly 2 years of sideways action. So that's why it's so important to be highly selective in what you're trading in the Australian market. This is the banks. They've obviously done the best. They've remained in uptrend during that period. So you can see there's quite a stark contrast between the trends in the banks and the rest of the market. Although having said that, healthcare indices have also done pretty well. And finally, wrapping it all up, looking at the ASX 200, we've had a net gain, but that's largely been on the banks, and the banks have now assumed a much higher proportion of the Australian market. But you can see these indices are really looking pretty much the same as the American ones. Now, turning to commodities, gold was flat on the week. I think it might have lost $1. So still in this big phase one base. So are gold stocks, the GDX index, unchanged. So really nothing different to last week. Silver also continuing to look shaky. It's holding support at the moment around $19, but I've got to say it's looking a bit shaky. Copper edged up just a fraction, I think 1 cent on the week. Oil also unchanged at $100 a barrel, so virtually no change in any of the major commodities. And you can see that from the copper price chart there. So this is the same slide as last week because absolutely nothing has changed. I think it's still a flick of a coin as to whether this correction is finished or not. I think the most likely outcome from here, the way it's setting up, is that we'll get a sideways range for perhaps several months. That can be difficult to trade because stocks just basically go down for a few days, then they go up for a few days, and then they just flick backwards and forwards. So it's not an easy trading period. You should be looking at focusing on buying the extremes. So you want to buy the sell-off days. I believe you should be holding some cash because we may just get something that might trigger a bit of a sell-off in the market. It could be to do with the Ukraine. It could be to do with some bad economic data out of China, although that seems to have turned around now. But there could just be some trigger that might cause a very short-term blip down in the market. So I think this is a good time of the year to be holding a bit of cash. Definitely get out of anything speculative and low quality because when the market gets nervous, those stocks just get smashed. And just really narrow your focus to the best stocks. If you don't know what they are, if you don't know what that means, if you don't know what they are for members or for people who aren't members of Specialist Share Education, then get in touch with me because I think there's plenty I can do to help you. Gold stocks still building in phase one. No change there. It's a frustratingly long period, but I'm convinced, looking at the supply and demand fundamentals, that gold stocks will eventually get back into an uptrend and there'll be some substantial gains to be made. So I'd be holding minimal exposure to precious metals at the moment and only the best quality gold stocks that you can find. So that's it for this week. For anyone that would like some more information about what we do, that's the website and my email address. Always happy to talk. Enjoy the rest of your weekend. Cheers.